Hi, I'm Audie. Welcome back, everyone. Today is Tuesday, July 7th, 2026, and we are looking at a pre-market cross-asset brief. The major themes dominating the morning are a conflict in the Strait of Hormuz, rising pressure on Treasury yields, and a squeeze on tech stocks. To set the stage, let's check where the major funds are currently trading. The S&P 500, SPY, is at $751.28. The Nasdaq QQQ is at $722.82. Small caps, IWM, are at $298.90. Treasury bonds, TLT, are at $85.45. Gold, GLD, is at $382.13, and oil, USO, is sitting at $104.35. There are three main forces shaping the market open today. First, we have a geopolitical shock, with oil prices jumping because two tankers were damaged near the Strait of Hormuz, making the market reprice the security risks of global shipping. Second, there is upward pressure on interest rates, with the U.S. 10-year Treasury yield climbing near 4.49% to 4.50% ahead of several Treasury auctions this week. Third, we are seeing weakness in the tech sector, with Nasdaq futures down about 1% due to fears that the AI chip cycle might be peaking following a profit warning from Samsung. Despite this headline-sensitive risk-off morning, the VIX, our market fear gauge, suggests there is no full panic just yet. To understand how geopolitics is actively pressuring stocks today, it helps to look at the chain reaction happening in the market. The tanker attacks in the Strait of Hormuz are creating a shipping risk premium, which causes oil prices to spike and pushes WTI crude towards $69.30. When oil goes up, inflation fears rise, which amplifies the risk that the Federal Reserve will stay hawkish, meaning they will want to keep interest rates high right before they release their latest meeting minutes. This pushes the 10-year Treasury yield up to 4.5%, and when these discount rates jump, it puts immediate downward pressure on stock valuations. Ultimately, this creates a squeeze on tech and long-duration assets, leading to a sell-off in funds like QQQ and TLT. Looking at the broader U.S. economy, we are seeing signs that growth is cooling down. But the Federal Reserve remains highly focused on fighting high prices. On the growth side, the ISM Services Index eased slightly to 54.0. And while June payrolls cooled sharply by only adding 57,000 jobs, the overall unemployment rate actually fell to 4.2%. This means the economy isn't weak enough to force the Fed to pivot and start cutting interest rates just to save it. Instead, the Fed is staying hawkish, with rates held steady between 3.50% and 3.75%. Especially since the ISM Prices Paid Index remains very elevated at 67.7, and Governor Waller is emphasizing the high risks of inflation. Because of this, the upcoming FOMC minutes are expected to tilt hawkish, meaning they will likely prioritize inflation control over economic expansion. Usually, in times of global stress, investors flock to commodities like oil and gold for safety. But today, we are seeing a clear winner and a lagger. Oil, tracked by the USO fund, is very bullish right now because it directly benefits from the shipping risks in the Strait of Hormuz, though it will need further escalation to overcome the larger, long-term oversupply of oil from OPEC. On the other hand, gold, GLD, is caught in a tug-of-war and is looking mixed to slightly bearish. While geopolitical fear usually pushes gold up, rising yields and a strong US dollar push it down. And today, those yields are winning, with spot gold dropping roughly 0.8% to near $4,129 an ounce. Despite all the intense news, the market's fear gauge, known as the VIX, is surprisingly contained near a level of 15.95. This tells us that options markets are not currently pricing in a massive systemic crash or a full-blown panic event. From a trading strategy perspective, this has both positive and negative impacts. The positive side is that the market isn't in a forced liquidation mode, which heavily favors selective, defined risk trades like debit spreads. The negative side is that selling naked premium, which is a much riskier options strategy, is highly dangerous right now in assets driven heavily by breaking headlines, like oil and gold. Let's break down the cross-asset biases and what's driving them today. The S&P 500 SPY and gold GLD are both looking mixed to slightly bearish, primarily driven by a tug-of-war between rising yields, high oil prices, and the contained VIX. Tech stocks, QQQ, and Treasury bonds, TLT, are both showing medium to high conviction bearish signals, pushed down heavily by the tech sell-off and the 10-year yield nearing 4.5%. Small caps, IWM, are also mixed to bearish due to growth uncertainty and higher yields. The only clear bullish asset on the board today is oil USO, driven directly by the shipping risks in Hormuz. So, where is the actual trading edge in the options market today? For SPY and GLD, the signals are conflicting, and there is a high risk of choppy, sudden moves based on headlines. So the smartest play is simply to wait for clarity. Small caps, IWM, offer a slight edge for a call credit spread, as their upside is firmly capped by those high interest rates. The cleanest directional clarity today belongs to TLT, QQQ, and USO. For these, the best edge lies in defined risk trades like put debits for TLT and QQQ and a call debit for USO. Our top trade focus for the session is a bullish call debit spread on oil USO. The catalyst for this trade is the direct, timely risk premium stemming from the tanker attacks, which maps extremely cleanly to rising crude prices. This specific option structure is ideal because it captures the upside from the ongoing geopolitical news while strictly capping how much money you can potentially lose. It is a much safer alternative to selling puts, which would leave you exposed to massive overnight losses if the tensions in the Middle East were to suddenly de-escalate. To execute this, you would buy a near-the-money call and sell an out-of-the-money call, aiming for 30 to 45 days until expiration to help keep costs down. Finally, we leave you with the defining question for today's trading session. Can the market absorb higher oil and higher yields without triggering a broader, tech-led de-risking move? If the answer is yes, we will likely see the S&P 500 stabilize quickly, the Nasdaq manage to recover from its morning drop, and the overall market damage will be contained. However, if the answer is no, the weakness we are seeing in tech and bonds will become highly contagious. In that scenario, this stops being a simple reaction to a morning headline and becomes the dominant signal driving all market assets for the rest of the week. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.